Ntibikize kandi mwaramutse bavandi, ese bari kwinjira muri ripoti mu bice rinki.
Eugênio não era nem hoje.
Hmm?
Eugênio não pensa que não
É mushyo.
é. Esse chama. Siko nta mazi mani. Ko sina amazi.
Kwa Kristo yanga n'intore.
Ah, hepfo. Siko umunsi wose nanyweye amazi.
Ubuze ntiyatashye.
Sije kusawara uyu mutima amajwi y'abagushima ni benshi uwiteka twese nziza twavuye mu isi y'amaraso rukangura amata tumenye nawe Isiraheli atatwera uri data wa twese byanditswe kera tutarabaho uri data wa twese nziza wanuye mu bise by'amaraso uri data wa twese nziza byanditswe kera tutarabaho
Tahira mani.
Uri data wa twese uza. Byanditswe kera tutarabaho.
Sije kusawara uyu mutima amajwi y'abagushima ni benshi uri data wa twese mwiza twavuye mu bise by'amaraso rukangura amata
Uri data wa twese muto avuye mu bisi by'amaraso umwizaza wa twese mwiza avuye mu bisi by'amaraso umwizaza.
Yes, good evening.
Good evening, sir.
So I hope you are ready for the session today. By show of heart, let me know whether we are ready for the class.
Class cuts.
Can we start?
Yes, we can. Go for it.
So I want us to continue from where we left last time. In our last lesson, we discussed merger and acquisition. And I want us to continue with the same today. The merger and acquisition. We see how much we can do for today. Now, in today's lesson, I want us to start with the valuation of target for the purpose of merger and acquisition. So we say that the acquiring company or firm is the creditor, while the firm being acquired is the target. The acquiring firm is the creditor, while the firm being acquired is the target. So it is always nice to remember that. So valuation of the target in case of merger and acquisition. Now, when you talk of the valuation, it is to determine the value that the creditor will place on the target for the purpose of the acquisition. It is very important so as to determine how much will be paid for this purpose. I want to give the methods that we can use in the valuation, and I'll start with the first one. It is called the net asset value method. And the net asset value method, we take the total assets, we offset the liability. The difference is the net value of the asset. We assume that this method is used in case the firm is liquidating, and therefore it excludes the intangible assets. So if you can look at what I'm displaying on the screen, this method value a company based on difference between the total assets and total liabilities. It is the net assets or the equity. So if you want to determine the net asset value, we say that net asset is equal to the sum of the assets, we minus sum of the liability, and it is known as the liquidating. As a result, the value of intangible assets, such as the patents, the goodwill, they are excluded in the total value. So if I could put it this way, I can say that the value of the total assets, this one excludes the intangible assets because they will not be realized. Let us look at the steps that you follow in this valuation method. Value all assets at market or fair value instead of the book value. So we use the market value or the fair value. We less all liabilities to arrive at the net assets. Then from there, we adjust for intangible assets. In case you have intangible assets, you are supposed to adjust. In simple terms, we are saying it is the total assets, if I could put it here, net of intangible assets. Net of intangible assets, meaning we exclude the intangible assets such as goodwill and patent. This is because they will not be realized in case of liquidation. We call it a liquidating method. Now, what are the advantages for this method? Number one is suitable for asset-heavy business, the business with a lot of assets. Then it is simple to calculate using the data provided in the statement of financial position. The disadvantages of this method is that it ignores the future earnings that are potential and the future cash flows. We are saying that it is about now, it is about today, it excludes the future. You assume that how much the asset would be realized if they were disposed. The other point is that it may understate value of intangible assets, that is the goodwill or the patent, the brand, which are significant. We are saying that we exclude them, and as a result, they could be of value if the farm was being sold as a going concern. The other thing is that the market value may differ significantly from the book value, requiring expert valuation. That means sometimes when you are determining the value of the assets, there could be big difference between the book value and the market value, hence calling for valuation or intervention of experts. So that is what we call the net asset value. It is one of the methods that we use to determine the value of the asset for the purpose of acquisition. The other method is the dividend growth model. The dividend growth model, we know that under the Meron-Gordon argument, Meron-Gordon provided the valuation model. So what we call the dividend growth model, it is a model that was derived by Meron-Gordon. It helped in the determination of the value of an entity. In this case, we assume that the farm is a going concern and it is expected to grow at a certain constant rate from one year to another in perpetuity. So it is simply the present value of growing annuity in perpetuity. So it values a company based on the present value of its expected future dividend growing at a constant rate. So we can say that it is therefore the present value of growing annuity. In this case, the annuity is dividends. In perpetuity. So when we are valuing the farm, we need to establish how much is the dividend today. Do we expect these dividends to grow? So we say that the value per share is equal to D1 over cost of equity minus the growth rate, where D1 is the expected dividend in the future or the next financial period. We can also say that this D1, let me put it this way, this D1, so that in case in future we get a different thing, this D1 is also equal to the D naught, let me put it this way, D naught. Like that, D naught in bracket into 1 plus G. So what is the D naught? What is this D naught? This D naught, we say that is the dividends for the year just ended. D naught is the dividend for the year just ended. Let me call them the dividend per share instead of calling it dividends per share for the year just ended. That is D naught. Then we have K is the required rate of return or the cost of equity. G is the dividend growth rate. So if you are given those variables, then you can comfortably determine the growth, the value per share. So it is the present value of growing dividends per annum in perpetuity. Now, for this method to be applicable, there are some assumptions that must hold true. Assumption number one is that dividends are expected to grow at a constant rate indefinitely. They will grow at a constant growth rate from one year to another in perpetuity. Number two, it is suitable for companies with stable and predictable dividend policies. So it may not be applicable for those companies that have their dividends fluctuating from time to time. It is applicable for those companies that are stable and have their dividend predictable. The advantage of this method is that it is easy to apply for mature dividend paying companies, and it focuses on the return to the shareholders. It is therefore the perception of the shareholders to the firm that is the basis of the valuation. It has its limitation. Number one, it is not suitable for companies that do not pay dividends and which or whose dividend policies are not predictable. Then we say that it is sensitive to estimate because of the estimation of the cost of equity and the growth rate. Sometimes it becomes difficult to get the cost of equity and to determine the growth rate. So we have talked about two methods, net assets method and the dividend growth rate model, the constant dividend growth model. Now let us look at the third method that we could use. We talk of the price earnings ratio. If we can remember, the price earnings ratio, it is a ratio that is based on the market value. So if I could try and give it this way, I say that the price earnings ratio is equal to market price per share, we divide by the earnings per share. So here we have the MPS. This is the market price per share. The market price per share. Then we have the EPS. This one is the earnings per share. The earnings per share, that is the EPS. So it will help us to determine the value of a share. So if you want to get the value of a share, we will take this MPS to be the subject. So the definition for this one, we say that values a company based on its earnings multiplied by the appropriate price earnings ratio. And this is what we are discussing here, and say that the value of a share is equal to the price earnings ratio multiplied by the earnings per share. Now note, if you want to get the value of a firm, let me say value of a firm, is equal to earnings times price earnings ratio. But if you want to get the value of a share, it is equal to EPS, we multiply by the price earnings ratio. The price earnings ratio, like that. So the value of a share and the value of a farm. I can say this is of a farm. The value of a farm, like that. So we are able to determine the value of a farm, and we are equally able to determine the value of a share. So that is what we call the price earnings ratio. When is it applicable? When do we apply this method? Number one, its application is determine maintainable earnings of the target. You determine the earnings that you expect the target will be earnings per year. Number two, you determine the price earnings ratio. We can determine the price earnings ratio from the historical data. You can determine from the market expected price earnings ratio. You can determine for the comparable companies in the industry. So we can get the price earnings ratio, but in most cases, we use the industry price earnings ratio. So that will help us to determine the value of the farm and also to determine the value of a share in a farm. What is its advantage? Number one, it is widely used in reality or in practice, and it is easy to communicate to the investors. The investors are likely to understand it. Then it reflects the market sentiment and comparable valuation. Its value in most cases is comparable. Like when you use the price earnings for the industry, then it means you will be able to compare with the other firms in the same industry. Now, what is its limitation? Is that price earnings ratio may vary between industries. It may even vary in firms of the same industry. Then the earnings may be manipulated. Remember, profits are based on the accounting policies. You can manipulate the profit of a firm to report high profit. If you report high profit, it will indicate high value of the firm. Then the other thing is that it ignores the investment in the farm. If you have a very big farm by asset, but it is making very little profit, then it means this method will be misleading, because not all the farm with huge asset base that make huge profits. Again, not every farm that make huge profit has a valuable asset. So there is a mismatch between the assets and the value. And therefore, those are the limitation of the price earnings ratio. I want you to ask a question. I want someone to ask a question so far before we can continue. So can I have, is there any question, please? I hope you can see my screen. Please, first, I need you to confirm whether you can see my screen. Please. Can someone confirm? Can you see my screen? Okay, the screen is visible. Good. Is there any question? The three methods that you have already discussed. Is there any question? If there isn't, I can move to the last method. So let's talk of the last method, the discounted cash flow method. The discounted cash flow method. This one. A cash flow model, we call it discounted cash flow model or the discounted cash flow method. What does this mean? You are supposed to estimate the future cash flows that will be generated by the target. You get the present value of such cash flows, you discount them. So the values it values a company based on the present value of the expected future cash flows that are discounted at the most appropriate discounting rate. We'll be looking at the various rates, the various way in which we can determine the discounting rate. But the bottom line is the discounted cash flow method deals with the present value of all the cash flows that are expected from a project. Now, what are the steps? Number one, forecast the free cash flows to the farm. That is, what are the cash flows that are expected from the farm? You try to forecast them. If you are determining them in perpetuity, forecast the expected cash flows to perpetuity. Or you can determine them for a number of years. Then you get the present value. Then we determine the terminal value to capture cash flows beyond the forecast period. If you want to get to the end, maybe there is a lifespan, you will determine the salvage value. If there isn't a lifespan, you can determine the cumulative future cash flow at the end of the growth rate. Then from there, discount all the cash flows to present value using the weighted average cost of capital. In this case, if the farm is geared. But if the farm is not geared, is purely equity financed, you determine the present value using the cost of equity. So we say that the value of the farm is equal to the summation of the cash flows in time period T, all the cash flows, divided by 1 plus the discounting rate plus the present value of the cash flows at the end. You divide by 1 plus R, that means you get the present value. So it is the present value of annual cash flows. You add present value of the terminal cash flows. Let me define it this way. Let me put it this way so that at least we can understand. We say that present, this one is the present value of the terminal, of the annual cash flows. Then we have this one is the present value of the terminal cash flows. This one is the present value of the terminal cash flows. Present value of the terminal cash flow. Now we need to determine the variables that we have used, and we are saying that CFT is the cash flows in year T, R is the discounting rate or the weighted average cost of capital if the farm is geared, or the cost of capital if the farm is not geared. We have the terminal value at the end of the forecast period. Then we have N is the number of years of the forecast, the period over which you are forecasting your cash flow. What are the advantages of the discounted cash flow method? Number one, it reflects the intrinsic. What is intrinsic value? It is the real. It is the true value. It reflects the intrinsic, the real, the true normal value. We call it also normal value. The intrinsic value is the true value, the normal value or the real value based on the future cash flows. Number two, it is suitable for the businesses with the cash flows that are predictable. The farms that you can predict the cash flows. Now, it got its own challenges, and one of the challenges is that it is sensitive to assumption. Since we are forecasting the cash flows, assumption, we are forecasting the discounting rate, another assumption, we are forecasting the terminal growth rate, another assumption. So all the variables are assumptions. So it has that limitation since it has so many assumptions and therefore it is sensitive to assumptions. Then it is complex and data intensive compared to other methods. You require a lot of data for you to use the discounted cash flow methods. For you to be able to use this method, you require a lot of data. The data that will help you determine the cash flow, the data that will help you determine the discounting rate,
bigeze kurema
the data that will help you determine the terminal cash flow, the data that will help you determine the life that you want to consider. All these data are based on assumption. So we say that it is sensitive to assumption and it is complex because it involves a lot of data. These are the methods that we'll be using in determining the value of a firm when it comes to the valuation of the target. So if someone has a question, I can respond before I take you to the next level. Someone says that I'm moving so fast. I want to hear whether you want us to move. Am I too fast? Someone says I'm moving too fast. So can we find out whether I'm moving so fast? If you am so fast, we can move slowly. Okay. Someone asked the question whether they are the only one who feel that I'm moving so fast, but I think they say no. But another question is, how do we know that? Oh, there was a question. How do we know that company is geared in question? That's a good question. That's a good question. I want to respond to that question. How do we know that a firm is geared in a question? A firm, okay, I will be explaining in the next step, but it is good to mention this. Geared or a levered firm means when you look at the capital structure of that firm, it has debt. You have equity and there is non-current liability. We say that firm is levered, that firm is geared. In case the firm capital structure does not have non-current liabilities, it only has the equity capital, then we say that that firm is not geared. It is ungeared. It is unlevered. That question, that's a good question, and I believe I have responded, because these are the things you find in the exam and you don't even understand how to deal with them, but we'll be looking at more details about that in the next phase. And now, when you look at the methods that I have mentioned, I have talked a lot about determining using the cost of equity, the price earnings ratio method, the discounted dividend method. We are using the cost of equity. Discounted cash flow method, we are using either cost of equity or the WACC. WACC is the weighted average cost of capital. So the question is, how do you determine the cost of equity? This is what I want to address at this point. Now, methods of determining the cost of equity. There are multiple methods that we can use to determine the cost of equity. The first one is the dividend growth model. We call it the Gordon's growth model. The Gordon's growth model. It helps us to determine the cost of equity. And we say that the cost of equity KE is equal to D1 over P naught plus G. I want to put it clear. Let me rephrase it so that we can understand. Cost of equity is equal to D1. This one we divide by I will use P naught, but I will be explaining P naught like that. So this we divide, then I will have plus G. So when you look at this one, let me try to squeeze it so that it can look a little professional. So this is the same as this part. Now, so it is D1 over P naught plus G. G is the growth rate. Let me put this part clear so that at least it can look good. Yeah, like that. Now, what is D1? It is the expected dividend next year, which is also equal to D naught, we had mentioned earlier, D naught into 1 plus G, like that. So that one will give us the value of D1, expected dividend. But again, we need to say that the D naught here, it is the dividend for the year just ended. The dividend, this is dividends per share for the year just ended. The dividend per share on the DPS for the year just ended. So we need to note that. Then we talk of P naught. I talked of this P naught. This is the current market price per share. It is the price at which shares are selling in the market. We say that it's P naught. Then G, it is the expected constant growth rate of dividend. So when determining the cost of equity, we can use the Gordon's model. Constant growth model. Now, the other one is the assumption. What do we assume? Is that dividend grow at a constant rate indefinitely. Hello, can you hear me? Find out whether you can hear me. You can hear me. I'm in the office and the power is gone. I don't know what has happened. So I had to reconnect the power. I hope that the power will be back because it's something that I had not foreseen. So I'm very sure the battery may not sustain the lesson to the end. But let's just continue. Now, we were saying the assumptions of the dividend growth model, and we've said that dividend grow at a constant rate indefinitely. So that is the basic assumption and the assumption that we make under this method. The advantage of this method is it is widely accepted. It is widely used. This model, if I could give a small history about dividend growth model by Myron Gordon, it was developed by one guy called Myron Gordon in 1965. It is as old as that, in 1965. And for years, it has been used in practice, in learning and in reality, in determining the value, cost of equity, and the valuation of the firm. And the good thing is that Myron Gordon, a university lecturer in US, he died in 2011, meaning that he enjoyed the time that the whole world used his model in the valuation and in determining the cost of equity. So it is simple and widely used if dividends data is available. The problem with this method is that it is not suitable if the firm does not pay dividend, and it is sensitive to the growth rate, because we are assuming a constant growth rate, but in reality, we may not have a constant growth rate in perpetuity. So there is a problem with that assumption, but again, because it is widely used, it makes more sense. Then it means we use it. It has been used, and that is the dividend, the Gordon's model or the dividend growth model in determining the cost of equity. If there is a question you can ask before I take you to the next method. Can we have someone ask a question? Let me check whether there is any question. Good, thank you, thank you. So there isn't any question. So allow me to take you to the next method that we use in determining the cost of equity. And this is what we call the capital asset pricing model. Some will call it CAPM, some will call it capital asset pricing model, depending on the way you want to go about it. How do we get the cost of equity? The cost of equity is equal to the risk-free rate plus beta factor of equity. RM is the expected return of the market, and the RF is the risk-free rate. And this is what I want to explain here. Now, the RF on the risk-free rate is based on the government securities. That is the treasury bills. The treasury bills, that is the best basis of determining the risk-free rate. The rate of return by the government securities, it is the risk-free rate. So risk-free rate RF. Note that when you see RF, it is risk-free rate, this one here. It is the risk-free rate. Then we go to the next one, B, the beta coefficient. That is the other thing that we need to understand. What is the meaning of the beta coefficient? What is the meaning of the beta coefficient? The beta coefficient is a factor. Just allow me 1 second. 1 second, please. Okay, fine. So I wanted to make you understand what is the meaning of the beta factor. The meaning of the beta factor. Beta is a measure of how sensitive a security is to what we call systematic risk. And I want you to understand that, but before then I can see some people have written some things, or
Systematic harya ni ishobora kuboneka.
we are hearing, yes,
Systematic
okay,
risk.
okay.
Risk ushobora
When do we use WACC? Okay, for that one I will explain. During discounting, okay, someone asked, has responded during discounting. I want to explain what is the meaning of the beta factor. The beta factor, but I will get back to it. We say that it is the measure of how sensitive a security is to systematic risk. I will give further details on that, of the beta factor, but it is good to note it is a measure of how sensitive a security return is to the systematic risk. I will explain all that. Now, remember,
iyihe se
itagira igihe
Hmm?
itagira igihe
Hashize iminota 45.
What is the meaning of this?
Network mubanye network
ikwiye bari
aragoretse arabuze.
Okay. What happened? Let me share again.
Ibi nibyo saba.
sonic
Hmm?
bizo ni sonic
Bya pratique.
ni mutagira
Hmm?
ni mutagira
Sesi turi mu mafomera mu kanya twanyaguza. Byereka ari bukoreshe ikibaho yatweretse.
ugera wadika
Byanditse nyuma ariko dore njye mba ndi ku karikodi mo. Kuraje urebe ni ibisanzwe se.
ni ibingi bizo kwiga gusa
Birarenga nyine nuko ntangiye nyuma ho gato.
niyo wakerewe
Oya kode birimo ko nari ndimo kurangaramo gake gake. Simbizi. Yagarutse da.
basi ikuvuga
Ntabwo iri kuvuga ariko yagarutse.
Oh, can you hear me now? No voice. Now, am I audible? I can see some people here say yes. Good. Okay. You will bear with me because my power has gone off. So I'm using an alternative internet, which may not be very reliable. In case we have a challenge, I'll see what to do. Good. If you can hear me and you can see my screen, allow me to proceed. When determining the capital assets, because someone is asking whether it is asset beta or equity beta, it is equity beta. Beta coefficient, measure of systematic risk, the beta factor of equity. Let me put it again here, the beta factor of equity. The beta factor of equity. The beta factor of equity. It is a measure of systematic risk, which I will be explaining later. And having explained the capital assets pricing model, I want to elaborate more on what is beta factor. I want to elaborate more on what is beta factor. Now, beta factor, I want us to move together, and I want to say that it is a measure of how sensitive a security is. It is a measure of how sensitive a security return is. A security return is to the systematic risk. It is a measure of how sensitive a security is to the systematic risk. But again, now this one come out, what is this systematic risk? Before we get to defining what is systematic risk, I would want you to get it right. During COVID, all firms were faced by a common problem. Like almost everybody in 2020 during COVID, they were faced by a common problem. In 2022, the global inflation rose. There is a time the inflation rate in Rwanda was so high, and that was a factor in determining the performance of firms. Now, inflation is not selective. When it happened to everyone. Rise in interest rate happened to everyone. The government policies will happen to everyone. So when they happen, there are firms which will be affected more than others. That what will measure the extent to which the performance of a firm is affected is what we call the beta factor. So it is a measure of systematic risk. But again, what is systematic risk? Systematic risk. So we say that these are macroeconomic factors, adversely affecting the performance of a firm, adversely affecting the performance of a firm. And they are general to all firms in a given industry. They are general to all firms in a given industry. That means the performance of the firm is affected by factors such as inflation. Inflation will hit all firms in a given industry. So in case of inflation, the only thing we need to ask ourselves, what is likely to happen in the performance? So we say that they will affect the performance of a firm in a given industry. But I can say, although some firms are more affected than others, than others. Some firms are more affected. Some firms will suffer more in case of systematic risk? Yes, there is inflation. That inflation will hit more farms than others. The alternative to systematic risk, but we'll be looking at this in a different topic, it is the unsystematic risk. Unsystematic risk. And it is important to note that systematic risk are not preventable. So we therefore call them undiversifiable. Undiversifiable risks. They are not preventable. They are general to all farms. Now, we talk of the next one is the issue to do with the unsystematic risk. The unsystematic risk, we say that they are diversifiable. They are all, let me put it this way, diversifiable risk. Let me put it correct.
Hey.
Just 1 minute. Oh, this thing has interfered even with my. Just, I don't know why it is misbehaving. Okay. Okay, unsystematic risk, unsystematic or diversifiable risk. Unsystematic or diversifiable. Unsystematic and diversifiable risk, we say that these are the macroeconomic factors. They are macroeconomic factors that adversely affect the farm's performance, but they are unique. They are unique. They are unique to a farm in isolation. I don't want to say much about this one because we will be looking at it under the portfolio analysis. But the bottom line is, unsystematic risks are preventable. There is something that you can do to prevent them. There is something that you can do to minimize them. So they are said to be unsystematic risk. Now, when it comes to the issue of the beta factor, it deals with systematic risk. The risks that are not, we can say that, such as inflation, global oil policies, the global oil policies. We have international sanctions. Yeah, among others. Now, forget about that. Where we are, we'll be dealing with that later in a different topic. But where we are on understanding the beta factor. So there is that what you call the ungeared beta factor and the geared beta factor. So the ungeared beta factor, it measures the business risk of farm without the effect of the debt. So it is simply operational risk excluding the financial risk. So we say that it is ungeared. there is no debt. Then on the other side, there is what we call the geared beta factor. And the geared beta factor, it is the beta factor for a firm with debt. So it measures the risk of equity investors considering both business risk and financial risk due to debt. So we need to understand there is the geared beta factor and the ungeared beta factor, which I want to give some more insight of the beta factor. And I want to say this. When it comes to the issue of the beta factor, it is a very important concept in finance. So there is that application of the beta factor. And what is the interpretation? When you are told that the beta factor is this much, beta factor of the market is said to be 1. The beta factor of the market is 1. The beta factor of government security is 0. Because we say that government securities are not affected by risk. But when it comes to the average, a good investment portfolio, we say that the beta factor is equal to 1. So 1 becomes the benchmark. And we say that if the beta factor is more than 1, then it means that the security is more affected or has higher sensitivity to systematic risk than the market. If the beta factor is less than 1, it means that the sensitivity of that security return is less than that of the market. And this is what I want us to understand. I want us to look at this. Let me make it a little here. Good. I want to interpret it. Number 1, let me put it in a tabular format so that we can have it. Yes, let us have it this way. So here we have beta value. How much is it? The beta value and the meaning. Number 1, if the beta is equal to 1, we say that the security moves in line with the market. Simply, we are saying that the beta factor of 1 shows the sensitivity of the market. And the market in this case, it is the general market. If the beta factor is greater than 1, we say that the security is more volatile. It has a higher risk than the market. It is more sensitive to the market, to the systematic risk than the market. If the beta factor is less than 1, as I said, it indicates that the security is less volatile. It is less sensitive to the systematic risk than the market. If the beta factor is equal to 1, we say that there is no risk. In most cases, we say when you hold the liquid cash, it is in its form. Government securities are considered to be risk-free, so we are saying that they are not sensitive to the systematic risk. And if the beta factor is less than 1, we say that it is moving opposite of the market. We got some things like the gold. They will always have a negative beta because for them, irrespective of whatever it is, their value will rise. The value of items like gold. If you invested in some items like gold, it means that they will always have a positive value. So we can say that they got a negative risk. Their sensitivity to risk is negative. And unless there is someone with a question so far, I would want to move to the next item. Let me check whether there are questions. If you have a question, you can post. Someone say, come again. I don't know at what point. The difference between the business risk and financial risk, that is a good question. Someone asked, what is the difference between the business risk and financial risk? I would want to explain this one, although I'll be explaining it later at some other topic when we go to the portfolio.
Industrial.
I want to put this explanation, and I hope you will remember it the way I will say. Business risk is also known as the total risk. Business risk is also known as the total risk. It is a combination of systematic risk and unsystematic risk. Simply, it is a combination of diversifiable risk and non-diversifiable risk. That is what we call the business risk or the total risk. Now, systematic risk is a component of business risk, and systematic risk is a component of business risk. The other question that you asked is financial risk. Financial risk, it is the volatility of the cash flows and returns because of the amount of debt in the capital structure. And please, as I continue, it is good you note my laptop might be getting out of power. And in case it get out of power without notice, know that I'm working on the reserve power. Okay, you will bear with me because the power is off. So what I was trying to explain is the question raised by someone between the financial risk and the total risk. And I want you to understand that financial risk, it is the volatility because of the amount of the debt in the capital structure. For example, if I take you as an individual, you are employed, you lose your job, but you did not have a loan, you are not likely to be more stressed like someone who loses the job and they have a debt. The problem is more for the one with the debt. So we say that financial risk, it is the risk that is associated or the volatility of the cash flow because of the amount of debt. And for that one, I know we'll be getting back to it in some later topics. Someone asked about beta is less than 1. The beta is greater than 1. More explanation. Beta is less than 1. Market is the standard. If the beta is less than 1, it means the security is less sensitive to systematic risk as compared to the market. When the beta is more than 1, it means that the return of a security in question is more sensitive to systematic risk than the market. That's the best definition. And since I cannot see any other question, we can continue. Now, we want to relate the beta when there is debt and the beta when there is no debt. And again, we look at it from a point of view if there is tax and if there is no taxation. We say beta of a geared farm. Good, we are lucky the power is back, so we will continue. Yeah, that's great. So let me just connect my laptop to power. Good. Now, very important point that I want to explain. I want us to understand that the issue of geared farm or levered farm, geared beta, levered beta means in presence of debt. Ungeared means in absence
Absence
of
of
debt
debt.
or unlevered. So to calculate geared beta from ungeared beta, we use the formula provided by two individuals, Mira and Modigliani, or Modigliani and Mira, in their prepositions. That is under the financing of a farm. But what is the bottom line is, if I am here, I have the beta factor for ungeared farm. I'll be using BU for ungeared farm, and I will be using BG for ungeared farm. In some sources, you will see this one written as BL, beta factor of a levered farm. So the beta factor of a farm with debt, given the beta factor of unlevered farm, is equal to beta factor of ungeared or unlevered farm multiplied by 1 plus debt over equity. So the BG here is the geared beta. The beta factor when the farm has debt, the geared beta of equity. B2 is the ungeared beta. Ungeared beta, we call it the asset beta. The beta of equity without debt. Now, D over E is debt to equity ratio. That is debt divided by equity. But the bottom line is beta factor of a geared farm is equal to beta factor of ungeared farm multiplied by 1 plus debt over equity. Is there a question before I introduce taxes? Any question before I introduce taxes?
Yavomye kwa logistic.
Ihose.
Kare.
Yeah.
Let me see whether someone has a question, because I would want you to understand. The question, are these benchmark related to the asset B? The beta factor farm. Question number 2. When you say sensitivity, what do you mean? It means
Sound.
if there is inflation, what is the behavior of the farm performance? When there is, let's say, a change in government policy, like the government say, all businesses to be closing at 6. There are some businesses that trade well during the day. They don't expect to trade in the evening. How sensitive is the response of the return? So that is what it means with the sensitivity. When that risk happen, what will happen to the return? Then the other question, where is the other question? I think I went back. Is equity beta equals to geared beta? The thing here is, it is the beta factor of equity for a geared farm, beta factor for equity of ungeared farm. So you need to understand it is the beta factor. Anytime we are talking about the beta factor, it is the beta factor of equity. So equity beta is either geared or ungeared. The other question is, it's the other way around, as in beta to be the ungeared. That question I don't understand. For the ungeared one, I don't understand what he's asking. are those benchmarks related to the asset beta or equity beta? I think I've explained that. The equity beta is the beta for equity. The asset beta is the beta factor for equity for ungeared firm. I think we can continue. We can move to the next item. And this one will bring us to adjusting for taxes. In case of taxation, we need to adjust the beta factor for that firm. We adjust it for the purpose of taxation. And the adjustment for the purpose of taxation, we say that tax affects the beta factor. So the beta factor for a geared firm is equal to the beta factor for ungeared firm multiplied by 1 plus debt over equity multiplied by 1 minus tax. So this one we say that is the beta factor for a geared firm for a geared firm in presence
Iyo muratangira ryari
in
bose?
presence of
Muratangira ryari?
taxation. I can also put it this way. Let me also put it this way so that you can understand. And please don't forget, because these are things that you expected to understand. I will remove this part of taxation. I'll say beta factor of a geared firm in absence of taxation. So you need to understand the two. The beta factor of a geared firm in presence of equity, of taxation, and in absence of taxation. Now, that is it. T is the corporate tax rate, and the others we've already discussed. D is the debt, equity, E is the equity, BU is the beta factor for ungeared firm, BG is the beta factor for a geared firm. Now, the next thing we need to look at is what are the advantages when it comes to the factors of beta. It adjusts for systematic risk. Then, widely acceptable in corporate. When we are determining the cost of equity, let me put it this way. Advantages of capital asset pricing model. The advantage of capital asset pricing model: 1, it adjusts for systematic risk. 2, it is widely accepted in corporate finance. Then the limitation that of capital asset pricing model is it requires accurate estimate of the beta and the market risk premium, and it also assumes investors are divisible and only systematic risk matters. It only captures the systematic risk. It ignores the other forms of unsystematic risk. Now, if someone has a question, I can respond, because I want us now to go to questions. I want us to go to past paper questions after I have finished this. So keep asking questions. Now, the other thing is we are still determining the cost of equity. Remember, we started with Gordon's model. We went to capital asset model. Number 3, I want us to look at the bond yield plus risk premium. We say that the adjusted risk-free, we call it the adjusted risk-free. Bonds are considered to be risk-free because of the guarantee of the return. So the cost of equity, if you use this method, although it is not commonly used, the cost of equity is equal to the cost of debt plus risk premium. The cost of equity is the cost of debt plus risk premium. So if I could put it this way, cost of equity is equal to the cost of debt or bond plus risk premium, like that. So the bond yield is the interest rate of the company's long-term debt or the cost of the bond. Then we talk of the risk premium. It is additional return for undertaking the risk. The providers of equity are more compensated by providers of debt because equity is considered to be more risky compared to the debt. Then the advantages of the risk-free rate plus risk premium. Number one, it is useful for firms with publicly traded debt. Because the publicly traded debt, it is very easy to determine them, to determine the cost. Number two, it is simple to estimate when the market data is available. Its problem is that it is subjective estimate of risk premium. The subjectivity in determining the risk premium. Now, the next one is what we call the earnings yield as a method of determining the cost of equity. And we say that the earnings yield is, we need first to determine the ratio, earnings yield. Earnings yield, let me put it here so that you can understand. Earnings yield is equal to earnings per share, earnings per share,
ndi kubona hano
per share,
bitarenze nka bingahe
you divide by
EPS harya
the market price per share. Market price per share.
MPS
So, assuming that the market is efficient, that the market is efficient, assuming that the market is efficient, then KE is equal to the earnings yield. That is the assumption. Therefore, cost of equity is equal to EPS over market price per share. That is the argument. This is where we get the cost of equity. We assume that the earnings yield is equal to the cost of equity. So if the earnings yield is equal to earnings per share over market price per share, then cost of equity is equal to earnings per share over the market price per share. Now, this is the inverse of the price earnings ratio, giving the implied cost of equity based on current earnings. That's okay. Then we have the limitation. It ignores growth prospect because it doesn't talk of the growth in earnings. Two, it assumes current earnings are maintainable. The firm have the current earnings, and these earnings will remain constant in perpetuity. And that is the issue to do with the cost of equity. I decided to introduce you to the APT. We call it APT or APM, but you note that I said it is an advanced method. I will briefly go through it because I don't want to complicate the already complicated life by inflation. So we say that under APT, we put into consideration more than one risk. Let me put it here. We say that APT stroke M, we call it APT stroke M. That is arbitrage, pricing, theory, or model. That is where the issue of the APT T and M come from. Arbitrage pricing model or arbitrage pricing theory is based on the argument that there are multiple risk factors. There are multiple risk factors affecting the performance of a firm. There are multiple risk factors affecting the performance of a firm. So it means that inflation can occur, global oil policies can change, there is war in Ukraine, there is government policies, all of them can happen at the same time. So how do we determine the return of a security? We use a model called APT. It is an advancement of CAPM. CAPM, we use an average beta factor. So the APT uses multiple beta factor. So the cost of equity is risk-free rate, like in CAPM plus beta factor under risk systematic 1. Under the risk factor 1, then we talk of the return under factor 1. The return of a portfolio under risk factor 1. Then we add beta factor under risk factor 2 multiplied by the return under risk factor 2 all the way to the beta factor under risk factor n multiplied by the return under risk factor n. But let's leave this one. We'll get into much details on it when we will be dealing with the portfolio theory. That is where we can get it, because I will give it step by step for you to understand. But in the bottom line, we are saying it captures factors like inflation, GDP growth, market index, a number of factors.
Plus domestic.
Its advantages is that it is more flexible than the capital asset pricing model. It captures more risk factor than capital asset pricing model, and it has a limitation of complexity. Sometimes it can be difficult, sometimes it may not be very easy to compute because of the complexity. And with that, I wanted you to understand the methods that we use in determining the value of a firm that is about to be acquired, or valuation of a firm in case of merger. I want to explain this further using a question from the past paper, but before then I need to see whether there is a question.
Ndebe yuwari. Aya manyagwa y'amazi nawe ari gutuma mpaguruka buri mwanya kandi
ikibazo bikora mu icyarimwe ubigiye mwa gake gake.
Someone is asking what is the formula of ungeared beta. Can ungeared firm has beta assets? We say that the asset beta is the beta of equity for ungeared firm. I think I have repeated that, but again, I will share these notes because I have written all that. All that I've said is in the notes. So I will share the notes so that you can confirm. I know sometimes when I explain, you may not get it, but when you read on the notes, you'll get it. So what I want us to do, I want us to go to the past papers. And I want you to open your past paper. Open November 2024, question 1. November 2024, question 1. November 2024, question 1. Open that question. So this is question number 1. If you are there, open the question. open the question in November 2024. We go to question number 1. I want to give you 1 minute to open.
Not one.
Hmm?
Not.
Oh yeah, first
Hey, you can't go.
November 24. One try here. Naza gukora zinga.
So if you have opened the question, let me know. Let me know so that we can continue. Someone is asking the key differences between APT and CAPM. Please let me handle that in portfolio. As I said, I didn't want to say a lot about APT. Let us deal with it under the portfolio, the topic on portfolio management.
Ngo bizaba byoroshye.
We might lose the track. So let me know when you are ready so that you can move. Yeah, I see some people are already there. I see. Yeah, good. So if you are there, let us continue. I also hope that you can see my screen. That is November 2024, question number 1. I want us to read through the question together. The question reads, question number 1, that is section A. Maraika Gorilla MG is a listed company in Kigali Stock Exchange operating in the mining sector, specifically in the extraction and processing of minerals. The board of directors is currently considering an urgent course of action after poor performance in the year just ended. The immediate option at hand is to implement strict control measures or cost control measures in chemical used in minerals processing. This has been identified as a single earliest activity in the company's operation and an area that may not be mechanized in the short run. In line with the above objective, Nyabugogo Limited, a company specializing in hazardous chemical production and disposal, has been identified as a possible acquisition target. Preliminary due diligence on Nyabugogo Limited has revealed that company is still owned by its original founders and that they may be willing to sell all their equity stake in the company at a minimum price of 8.5 billion Rwandan francs. The company has never paid dividend before. However, as a result of interest shown by MG, the directors have equated annual salaries paid to them as dividend, and this amounts to an equivalent of 189 Rwandan francs worth of dividend per share. Though Nyabugogo Limited is a privately owned company, it is considered as the market leader in the sector. It has state-of-the-art technology in chemical processing and waste management. It employs some of the best chemical engineers in the market and has a huge budget allocated to research and development. Nyabugogo Limited is the only company in the sector that has never been penalized by the Environmental Authority for pollution-related offenses. To help in valuation of the possible offer price, the following information has been provided. Item, we have Maraika Gorilla, Nyabugogo Limited, the currency in million of Rwandan francs, non-current assets that are tangible, goodwill, current assets, total. Ordinary share capital valued at 1,000 Rwandan francs per value, long-term loan, and the total. Continuation item, we have the turnover for each of the two companies, earnings per share for each of the two companies, the price earnings ratio, then we have the beta for equity. The following information has been provided. Number one, sector price earnings ratio of chemical and waste disposal companies is 25:1. Number two, corporate tax is 30% payable in the same year as the revenue to which it arises. 3, risk-free rate is 6% and market premium is 4.82%. 4, debt can be assumed to have a beta of 0. Number 5, should MG acquire Nyabugogo Limited, it is expected that the turnover will grow at 5% per annum for unforeseeable future. The above turnover is based on the million cubic liters that Nyabugogo may process per year, which is currently at 6.5 million cubic liters at price of Rwandan francs 1,000 per liter. Number 6, before tax contribution to sales ratio is 30%. Number 7, tangible non-current assets of Nyabugogo may be sold at 20% above the carrying value indicated above. Included in the current asset is the receivable, which has since gone bankrupt, amounting to 200 million Rwandan francs. Required, calculate the price or a range of price that Maraika Gorilla should offer to purchase equity stake in Nyabugogo Limited. Calculate the price or range of prices
Which is
that Maraika Gorilla should offer to purchase equity stake in Nyabugogo Limited. 20 marks. Let me see what is in part B. The chief finance officer of MG has argued that 5% growth rate in sales revenue is unrealistic and too optimistic given green agenda currently being fronted by the major economies, assuming no growth in sales revenue and planning time period of 5 years only, and that a minimum price suggested by the owner of Nyabugogo will be offered. The required, calculate the sensitivity of the above. That is a sensitivity analysis. That is a different topic. Using the information, calculate the risk of the above project and interpret the answer. Okay. So I want us to go to
Question 2.
the topic that we are on merger and acquisition. It's a good question. It's a good question. I want you to read through the question. I want us to read through the question. I will give you some 2 minutes to read through the question. Open the question. I'm giving you 2 minutes. Once you are finished, let me know.
Nice.
Let me know when you finish.
Maraika Gorilla
Read.
is listed the company
I want to
Chicago
give you
Stock
some 2-3
Exchange,
minutes.
operating
Then you
in
let me know
mining
when you are
sector,
done.
especially in the extraction and the processing of minerals. The board of directors is currently considering an urgent course of action after poor performance in the year just ended. The immediate solution at hand is to implement strict cost control measures in chemical used in mineral processing. This has been identified as a single costliest activity in the company operation and an area that may not be mechanized in the short term. In line with the above objective, Nyabugogo Limited, a company specializing in hazardous chemical production and disposal, has been identified as possible acquisition target. Target. Nyabugogo Limited, a company specializing in hazardous chemical production and disposal, has been identified as possible acquisition target. Nyabugogo is acquired. Preliminary due diligence on Nyabugogo Limited has revealed that the company is still owned by its original founders and that they may be willing to sell all their equity stake in the company at minimum net price of miliyoni miliyari 8 n'igice. Simple as that. The company has never paid dividend before. However, as a result of interest shown by Maraika Gorilla, the director has equated annual salary paid to them as dividend, and this amount to an equivalent of this worth dividend per share. Though Nyabugogo Limited is a private.
So when you have finished reading, let me know so that you can continue.
As the market leader in sector. Nyabugogo nobody ariko yari market leader. It has state of the art mergers and acquisition.
So I think I can see some people have finished. I want us to get to the bottom of this problem, and I will read it again. So that you can understand. I said last time, understanding the question in an examination is critical. If you don't understand, you will be in trouble. I read, Maraika Gorilla MG is a listed company in Kigali Stock Exchange operating in the mining sector, specifically in the extraction and processing of minerals. The board of directors is currently considering an urgent course of action after poor performance in the year just ended. The immediate option at hand is to implement strict cost control measures in chemical used in mineral processing. This has been identified as the single costliest activity in the company's operation and an area that may not be mechanized in the short run. In line with the above objective, Nyabugogo Limited, a company specializing in the hazardous chemical production and disposal, has been identified as a possible acquisition target. Preliminary due diligence on Nyabugogo Limited has revealed that the company is still owned by its original founders and that they may be willing to sell all their equity stake in the companies at a minimum net price of Rwandan francs 8.5 billion. The company has never paid dividend before, however. As a result of interest shown by MG, the directors have equated annual salaries paid to them as dividend, and this amount to an equivalent of Rwandan francs 189 worth of dividend per share. Though Nyabugogo Limited is a private-owned company, it is considered as the market leader in the sector. It has state-of-the-art technology in chemical processing and waste management. It employs some of the best chemical engineers in the market and has a huge budget allocation to research and development. Nyabugogo Limited is the only company in the sector that has never been penalized by the Environmental Authority for pollution-related offenses. To help in valuation of the possible offer price, the following information has been provided. We have the two companies, that is Maraika Gorilla, then Nyabugogo Limited. The currencies in million of Rwandan francs. Non-current assets that are tangible, goodwill, current assets, and the total. Then we are given the ordinary share capital whose par value is 1,000 Rwandan francs, the long-term loan. Then we are given total. Further information is provided for each of the companies: turnover, earnings per share, that is EPS in Rwandan francs, price earnings ratio, and the beta factor for equity. The following information has been provided. Number one, sector price earnings ratio of chemical and waste disposal. Company is 25. Number two, corporate tax is 30% payable in the same year as the revenue to which it arises. Number three, risk-free rate is 6% and market premium is 4.82%. Number four, debt can be assumed to have a beta of 0. Number five, should MG acquire Nyabugogo Limited, it is expected that the turnover will grow by 5% per annum for the unforeseeable future. The above turnover is based on the million cubic meters that Nyabugogo may process per year, which is currently at 6.5 million cubic meters at a price of Rwandan francs 1,000 per liter. Number six, before tax contribution to sales ratio is 30%. Number seven, tangible non-current assets of Nyabugogo Limited may be sold at 20% above the carrying value indicated above. The current value indicated above. Included in the current assets is a receivable which has since gone bankrupt, amounting to Rwandan francs 200 million. Required. Calculate the price or a range of price that Maraika Gorilla should offer to purchase equity stake in Nyabugogo Limited. That is a nice question. For us to answer this question, I want us to take a commercial break of 5 minutes. It is always good to stretch when you are seated for long. You can also take a glass of water so that we move the next phase together. You are due for 5 minutes commercial break that starts now.
Bureke y'abacuruzi ndakurahiye.
So I think the commercial break is over. We can go back to the question. Let us now try to understand or try to answer it together. We see whether in an examination scenario you would have something to give the examiner. Remember, this question is 20 marks. It's 20 marks. So I want us to get to it. We try to identify what we need where. We are told that Maraika Gorilla is a listed company in Kigali Stock Exchange, operating in the mining sector, specifically in the extraction and processing of minerals. The board of directors are currently considering the urgent course of action after poor performance in the year just ended. The immediate option at hand is to implement strict cost control measures in chemical used in mineral processing. This has been identified as a single costliest activity in the company's operation and an area that may not be matched in the short run, mechanized in the short run. In line with the above objective, Nyabugongo Limited, a company specialized in hazardous chemical production and disposal, has been identified as a possible or a potential acquisition target. Primary due diligence on Nyabugongo Limited has revealed that the company is still owned by its original founders and that they may be willing to sell all their equity stake in the company at a minimum net price of 8.5 billion. They have attached a price there. The company has never paid dividends before, however, as a result of interest shown by MG, the directors have equated annual salaries paid to them as dividend. This amounts to an equivalent of Rwandan francs 189 worth of dividend per share. Though Nyabugongo Limited is a privately owned company, it is considered as a market leader in the sector. It has state-of-art technology in chemical processing and waste management. It employs some of the best chemical engineers in the market and has a huge budget allocation to research and development. Nyabugogo Limited is the only company in the sector that has never been penalized by the Environmental Authority for pollution-related offenses. To help in valuation of the possible offer price, the following information has been provided. We have, remember up there, we are given the dividend per share, this one, dividend per share. Now down here, we have more data. We are given assets, goodwill, current assets, some of the assets. Then we have actually it is a summary balance sheet, ordinary share, long-term loans, like that. So that is another information that can help us in valuation. Then we have the income statement, turnover, earnings per share, price earnings ratio, beta of equity. Again, there we can use some information to determine the value of a share. Now, I want us to do this. Let's see what to start with. Because we are given the earnings per share first, the DPS first, let us use the dividend model. Allow me to stop sharing this one. I share my...
You are blackboarding, whiteboarding. Recording a man. Recording.
The question was November 2024. Question 1. I want us to try and work on it together. Like that. So we talked of different valuation models. And considering that you are given the dividends, from the additional information, do we have any information about the
Hiyo
growth of the
nayo
dividend?
sera.
Sector price earnings ratio
Hiyo
is
nayo
25,
narindi
corporate tax rate is 30, risk-free rate is 6, and a premium of 4. Debt can be assumed to have a beta of 0. Should MG acquire Nyabugogo Limited, it is expected that the turnover will grow at 5% per year for unforeseeable future. The above turnover is based on the million cubic liters that Nyabugogo may process per year, which is currently at 6.5 million cubic liters at a price of 1,000 per liter. Before tax contribution to sales ratio is 30%. Tangible and current assets of Nyabugogo may be sold at 20% above the carrying value indicated above. Included in the current assets is a receivable that will not be recovered. So suppose we start with the one whose information is much available up there. Let's look at it. Can we start with the net asset value? Let us start with the net asset value. Net assets value. Now, if you remember under the net asset value, we said that the value of a farm is equal to the total tangible asset minus total liabilities.
Yes.
I want us to do it. We see how to go about this. We say that value